Hello, I'm Pam Minish, Managing Director at H&H for Investment Advisory. We're providing some additional information to plan participants regarding recent market volatility and how you might want to think about these conditions and your retirement savings. So we're going to walk through what's going on in the financial markets right now, the current bond market and changes in interest rates that were recently announced by the Federal Reserve, perspectives on inflation that we're all dealing with right now, consumer sentiment and how we're all feeling about spending the money that we have to spend, and then some takeaways for you as a long-term investor, how to navigate a situation like we're in right now. So let's get started here. I just want to remind everyone what we already know, which is the stock market has cooled down a lot in the last several months. This is a chart showing us the action in the S&P 500, the NASDAQ, the Russell 2000, which are smaller cap stocks, and the Dow Jones, just showing you that over the last several months, we've had a significant downdraft in all of these indices here in the United States, and indeed internationally as well. Stock markets are down across the board. We've had particularly strong downdraft in tech stocks. So the NASDAQ is actually down about 23% year over year. It's down about 30% just since 2022 began, and the S&P 500 is down about 16% or so since 2022 began. So we actually are in a situation where we've had a lot of correction going on in the market, cooling off, particularly in these high-flying tech stocks, and it seems to be continuing even as I speak. But some of this is actually good news. We've had a balloon that's been pretty full of the air in the stock market, and it looks like things are starting to come back down to earth a little bit. I wanted to show you what the price earnings ratio, or what you're paying in the market for the earnings that corporations create through their operations, what you're paying for those stocks, it has gotten cheaper. So things are a little bit more on sale now, if you will. We think things may get a little bit more on sale, perhaps here as the weeks increase through the summertime, hard to say, but suffice it to say that you're not paying as much for those corporate earnings now as you were just several months ago. The PE ratios back then were 23, 22 times price earnings ratio. At this point, we're down around 15.6 times for price earnings ratio. This is below the 25-year average of about 16.8 times. So this is encouraging to see these multiples come down. The real question is whether or not corporate profits and earnings are going to hang in there and continue to be as strong as they have been. And that's what the market is beginning to sense, is that earnings may soften up here a little bit so that these PE ratios may be adjusting over time. It may not be as attractive a market as it appears to be right now based on these earnings that are historic. We've had a very significant rise in interest rates, as we all know, in the last few months. I just wanted to show you what the market is anticipating for the Fed funds rate, which is an overnight benchmark rate that the Federal Reserve creates. We have, looking ahead just until December of this year, the market is anticipating that this overnight rate is going to be somewhere between 3.25 and 4%. So this is a significant increase compared to last year when we basically had zero for overnight Fed funds rate. We're anticipating that we are going to have another 50 to 75 basis point increase in interest rates here in the next month, so in July or so. We just yesterday, I'm talking to you on the 15th of June, just yesterday, a 75 basis point or 0.75% increase in the benchmark Fed funds rate was announced by the Federal Reserve. Suffice it to say that interest rates are increasing rapidly as the Fed is attempting to deal with inflation. Whether or not this action is actually going to help us with our inflation, since so much of it is wrapped up in energy prices and food prices, is very difficult to say. The yield curve is hinting at a recession risk in the economy. So if we take a look at this graph, the top chart, or the top line here, is showing you what current interest rates are And this is where we were just back at the end of 2021. So we see that we've had a significant ramp up of interest rates, but we also see that the yield curve itself is starting to flatten out here a little bit. And these short-term rates are rising rapidly. So we see a situation when the yield curve flattens like this, it can mean that the market is anticipating some softness in the economy going forward. In other words, a risk of recession. It doesn't necessarily indicate that will happen, but it hints at it. So the market is starting to think a little bit more about the risk to economic growth that comes out of this inflation that we're dealing with, not just simply the inflation being difficult, but the implications of what that inflation will be going forward. Just to remind everybody, back in May, we had a big surprise on the increase in prices. Month over month, we were up 1% in overall inflation in the economy and 8.6% year over year. But really what's interesting is diving into those individual components of inflation. Gasoline is up over 48% year over year, and we all feel this in the market as we're filling up our tanks at the end of the week. Food at home, so groceries, up nearly 12% year over year. These are the kinds of things that we feel in a very immediate way. So this inflation can feel a little overwhelming, and we wonder how long it's going to take for things to cool down. And that's part of what's going on with the Fed's action, an attempt to bring this inflation down and under control. Consumer sentiment, as a result of all of this volatility and inflation, has hit a record low. We have not seen a consumer sentiment reading this low before. We're at 50.2, going all the way back into the 70s when we first started taking this poll that's run by the University of Michigan. We've not seen levels of consumer sentiment that have been so low. So this can indicate that people are worried about spending money, that they feel like they need to be more conservative about their spending. But when we see consumer sentiment low like this, it can actually signal that there's an opportunity to realize some pretty good returns in the market over a longer period of time. And I'd like to show you what I mean by that. But first, let's talk about how we react to the market emotionally when things are very volatile, when it gets a little scary out there. So we've just come off of a very positive long-term performance in the stock market, notwithstanding the downdraft in 2020. Things have been good in the stock market overall for a number of years. And so we've had a good time of it, and people have felt good about the market until recently. And now what we have is a situation where we're starting to move from our euphoria and our excitement about how the market is doing down into a fearful area where we're a little concerned about what this all may mean, that the market is starting to correct. And what we find is, as the markets correct and we get to a point where everything feels as though it's just a little hopeless for people who invest, the despondency sets in, depression about the state of the market. But the reality is, it's at this point in the market, this most significantly down period in the market, where we have maximum financial opportunity, because everybody is concerned about the market being in a poor condition. What we find is that the returns after a period like this are actually quite strong. So let's take a look at some data going back decades on this. Consumer sentiment is tracked since 1971 with this gray line. And what I wanted to show you is what happens just 12 months after very low consumer sentiment readings. If we go back to 1990 in October, this consumer sentiment was at about 65. The next 12 months, we had a return in the stock market of 29.1%, very strong. Going back to 2008, which we all remember pretty well, the next 12 months after this really low consumer sentiment, we had a 22% increase. And even going back to April 2020, when we know things were feeling pretty scary with the pandemic, we had a 43.6% increase after this fall off in consumer sentiment. I'm not saying that we necessarily are going to have huge positive returns out of this, but the data going back for all of these years would indicate that the chances are good that we're going to have pretty strong returns coming out of this very, very problematic consumer sentiment situation. So successful investing is about staying in the market. It's about being in the market. If you try to time the market, you stand a very good chance of getting caught up and missing the best trading days of the year. Why is that? Well, the data tells us that 7 of the best 10 trading days occur within 2 weeks of the 10 worst trading days. So if we pay attention to the worst trading days and we get out of the market then, we miss those good days that are invariably within pretty short within short order after the bad days. Let's take a look at what the impact of that would be. So this is going back to 2020 to 2002 to 2021, so about 20 years of data. What would have happened if you just put $10,000 in the market and let it ride in the S&P 500 without making any changes at all? You would have had a return of 9.52%. If you missed the best 10 trading days of the years in that data range, so 20 years. If you miss the 10 best days over those 20 years, your return drops down to 5.3%. That is nearly a halving of the return that you would have experienced if you had just stayed invested. And if you miss the best 20 days of trading during that period, you would have only had a 2.63% return. These are material differences in the outcome of your retirement savings and your ability to reach your goals in retirement. So we're just trying to impart to you the importance of staying in the market, even in these downdrafts, because the good times come pretty quickly after the bad times. If we miss the good times, we miss these kinds of returns here. And volatility of returns is reduced over longer periods of time. If we're just investing for 1 year, we could see stock returns that could be a negative number, pretty significantly negative, up to a pretty positive number. But if we're investing over longer periods of time, what we find is we have more stability in the returns. So if we are investing over 10 years of time, we've got returns in the equity market that are generally quite positive. Maybe negative 1% would be the maximum downdraft over this period of time, which is 70 years. But we see positive returns across the board for very long-term investors. So when you think about the volatility we're seeing now, think about it being within the context of just a short period of time. You're a long-term investor. A long-term investor needs to think about these kinds of dynamics here, out 10 years, 20 years, not what's going on here. Big losses can come your way if you try to game what's going on in these short periods of time. Diversified portfolios will suggest positive returns, and the data bears this out. A 40% equity, that means stocks, 40% stock, 60% bond portfolio from 1966 to the year 2000. These were the returns that were experienced with that portfolio fully invested each of those years. And what you see is there are only 6 calendar years over that very large amount of time where you had a negative return. Most of the time, you had positive returns with a well-diversified portfolio. And despite volatility each year, markets settle up more than they settle down. They may have a lot of volatility in the middle of the year, but they typically settle up. And this is a picture of what I mean. The red dots that you see here for each calendar year represent how much the market dropped at some point during that year. And what we see with the gray bars is where the market actually settled at the end of the year. So I'll just point out a year we all remember very well, 2020, when the pandemic was setting in. We actually had a drop in the stock market of 34% at one point that spring in 2020. But by the end of the year, we had a positive return of 16%. And indeed, if you look at this data going all the way back to 1980, you're going to see more gray bars above this 0 line So more positive returns, then you see the market settling down. Your chances of the market settling up over longer periods of time is much, much better than the chances of these more rare occurrences where we settle down. So staying invested and riding through this volatility gives you a better chance at this kind of performance. So diversification, what we really mean when we talk about diversification is not putting all of your eggs in one basket. And by that, I mean having a mix of different asset classes in your portfolio. So large cap stocks, small cap stocks, international stocks, a little fixed income, a little bit of cash sometimes in portfolios. And what we see with this return quilt that goes all the way back to 2007 is that every single year, you're not going to see one asset class that is the top performer, and you're not going to see one asset class that is always the bottom performer. Everything switches around a little bit. And that's the beautiful thing about diversification. If you have a little bit of all of this, you participate in a little bit of all of this. So this line right here shows you what the returns were for a fully diversified portfolio during that particular calendar year. And you're going to notice that generally speaking, it's a pretty good return. There are a few negative years, but there are a lot of positive years there too. Now, if you're invested in a target date fund, your target date fund does this work for you. It is automatically diversified, and it automatically adjusts the risk as you reach closer and closer to retirement years. And I'll show you what I mean by that in just a minute. But I'll just point out, year to date, we only have 2 asset classes that have had non-negative returns: commodities and cash. So you probably have a lot of active investments in your portfolio or target date funds. You probably are seeing negative numbers, and you are in very good company. You are not alone. This is just what has been going on in the market, and millions of people all over the United States with their defined contribution plans have experienced these losses too. Remember, these losses are a temporary situation. The markets eventually do rebound. So again, your target date fund takes the worry out of the asset allocation question for you. What this orange line represents is the amount of equity that is in a target date fund 50 years before retirement, 25 years before, 5 years before, and this gray line would be when you turn 65. And what we see, this is one particular target date fund, and I'm really using it as an illustration, is that the equity percentage in the portfolio drops every single year as you near retirement. And what we wind up with is a much lower retirement equity percentage than we had when we were younger with the target date fund. So as you're nearing retirement, your equity portfolio in a target date fund may be more like 60% or 65%, not 100%, not 90%, not 80%. So take some heart if you're invested in a target date fund that this asset allocation change is taking a lot of the risk out of the portfolio right at the time that you need risk to be taken out of the portfolio. So a few points just to wrap up my comments today. Investing is a long-term opportunity, and it comes with ups and downs, and that is a natural part of investing. What we are experiencing right now is a natural part of investing. And if you want the upside, you have to be able to live with the downside that invariably comes during that investing period of time. Diversification will improve your risk and return trade-off over time, and try to keep control over your emotions when we have volatility like this. If you can control your emotions through that wave that we just looked at of euphoria to despondency, you're going to find yourself a more successful investor. If you can hold steady through this time, you can maximize your future value of your retirement savings. And another point, when markets correct significantly, either to the upside or the downside, reevaluate your portfolio risk. Think about how much equity or stock you really want to have in your portfolio. We've had a big drop in stock valuations in the last 6 months. It could be that your portfolio is a little lighter on stocks now than it was just a few months ago. Sometimes it can be beneficial to begin to dollar cost average or buy a little bit more into the market as it's been weak. Likewise, when the market is really strong, it might be a good time to pare back some of those riskier investments just to keep things a little bit more in balance. But above all, remember it's about being in the market and staying invested through these volatile times. I hope this has been helpful to you. Please reach out to us if there's anything we can do to help you understand what's going on and how to think about these dynamics in the market. Thank you very much. Have a lovely day.